A U.S. national bank just launched a digital dollar that can move around the clock with near-instant settlement at the tap-to-send speed people associate with texting. And that single upgrade doesn't just make payments faster. It upgrades the speed of fear. Because a classic bank run isn't just about money. It's about time. It's about friction. It's about the fact that panic has always had to fight through cutoff hours, settlement windows, weekends, and human bottlenecks. Those delays are ugly, inconvenient, and expensive, but they also act like shock absorbers. Today's story is about SoFiUSD, a newly launched dollar-pegged stablecoin issued by SoFi Bank, NA, on a public, permissionless blockchain, marketed as fully reserved 1:1 by cash for immediate redemption, and positioned as settlement infrastructure that partners can plug into 24/7. SoFi also says the same bank-grade framework can be used by banks, fintechs, and enterprises to issue white-label, branded stablecoins or integrate SoFiUSD into their own flows. At launch, it's being used for internal settlement, with broader availability expected over the coming months. That's the headline. Here's the uncomfortable part. Even if a stablecoin is truly fully backed, even if reserves are pristine, even if the token never breaks its peg, the behavior it enables can still make the system more fragile. Not because the coin fails, but because it succeeds too well. So if you stay with me, you'll walk away with three things. First, the difference between a run on a stablecoin and a run through a stablecoin. Second, why fully reserved can still translate into faster systemic stress. And third, the one question you should ask anytime someone sells you an instant dollar as a stability upgrade. Now picture a bank run the old way. The movie version is people standing outside a branch with worried faces. The modern version is quieter. Money leaving through apps and online dashboards. But even the modern version still has friction. Large wires have hours. Some transfers pause overnight. Weekends slow the rails. Compliance reviews happen. Batches settle. And in that delay, banks have a chance to borrow liquidity, pledge assets, raise emergency funding, talk to regulators, and stop a rumor from turning into a stampede. Time is what lets the system breathe. A stablecoin removes time. That's the entire point. A tokenized dollar can settle quickly, continuously, and transparently across networks that don't close on Friday afternoon. Can cut fees. Can reduce settlement delays. It can make cross-border payments less punishing. It can help businesses reconcile funds without waiting days. All of that is real value. But it also creates an exit door that never closes. And the moment there's a door that never closes, people start planning their escape routes in advance, even if they never use them. That planning changes incentives. And when incentives change, stability changes. Here's where people misunderstand the risk. They hear fully reserved and mentally check out. They assume the story ends there. Like, okay, backed by cash, so what's the problem? The problem isn't only what an asset is. The problem is what crowds do with it and how quickly they can do it. Think about fire safety. A building can have sprinklers, alarms, exits, fire doors, and still be dangerous if the exits create a stampede when everyone moves at once. Sprinklers reduce risk. They don't erase the physics of crowds. In money, the physics of crowds is liquidity timing. So let's make the mechanics simple. A stablecoin is a promise. One token can be redeemed for $1. To keep that promise, the issuer holds reserves. The cleaner the reserves, the stronger the promise. SoFi's own language emphasizes cash reserves and immediate redemption capability, and it highlights the bank's ability to keep reserves in cash at its federal bank account. If you're watching only the stablecoin itself, that sounds reassuring. But we're not watching only the stablecoin. We're watching the system around it. Because banks don't exist to store cash in a vault. Banks exist to transform short-term funding into longer-term assets. Mortgages, loans, securities. That maturity transformation is the business model. It works because not everyone demands their money at once. A bank run is simply a funding shock that arrives faster than the bank can meet it. And here's the twist. You don't need people withdrawing physical cash to have a run. You need people withdrawing confidence, and then withdrawing funding in the fastest form available. Now I want to introduce the two runs, because this is where the whole story flips from crypto talk into financial plumbing. Run number 1 is a run on the stablecoin. That's the classic stablecoin nightmare. Holders lose confidence in the issuer or reserves, they rush to redeem, and the peg comes under pressure. The token itself becomes the victim. Run number 2 is a run through the stablecoin. That's when the stablecoin stays stable, redemption works, reserves are fine, and the token becomes a tunnel that speeds up withdrawals from somewhere else. The stablecoin isn't the thing being run on. It's the thing being used to run. If stablecoins become the fastest better dollar, then during stress, everyone tries to move into that better dollar at the same time. Not because they love stablecoins, but because the cost of moving early is tiny, and the cost of moving late can be catastrophic. That asymmetry is everything. Now let's make it real. Here's a scenario that is boring, plausible, and therefore dangerous. You're the CFO of a mid-sized company. Payroll hits Monday. You keep operating cash in a bank account. On Friday night, a rumor starts spreading. A major lender is under stress. Funding markets are tight, and a few institutions might be exposed. You don't know if it's true. But you do know this. If you're wrong and you wait, you could miss payroll. And missing payroll isn't an oops. It's lawsuits, resignations, operational collapse, and the end of your job. So you make the rational choice, you move the cash to the safest, most mobile form you can access right now. In the old world, you might attempt a wire, but it's Friday night. Or you might initiate an ACH transfer, but settlement has cycles and delays. Or you might split transfers, but you still hit friction. In the stablecoin world, if your bank offers a bank-issued stablecoin rail, you can convert and move value immediately, continuously, while everyone else is debating whether the rumor is real. Now multiply that CFO by 10,000 CFOs. Then add households who see the same rumor and think, why risk it? Then add wealth managers whose clients demand action before Monday. Then add algorithms. This is the turning point. It's not about whether the rumor is true. It's about whether the exit is fast enough that doing just in case becomes the rational default. And when just in case becomes default behavior, the system becomes twitchy. At that point, even a healthy bank can be destabilized, not because it's insolvent, but because it can't meet instantaneous outflows without selling assets into a falling market, which creates visible stress, which creates more outflows. That's how feedback loops are born, not from evil but from speed. This is why I keep saying the system has always relied on time. Not because time is good. Time is awful. Time is fees, delays, and friction. But time also gives the system moments to coordinate. Central bank facilities, emergency liquidity, communication, backstops, weekend containment. A public, permissionless blockchain doesn't care about weekends. It doesn't care about business hours. It doesn't care that the people who would normally coordinate a response are asleep. And that's why the phrase, a run that happens while you're asleep, isn't just dramatic writing. It's the logical conclusion of building 24/7 rails for money and then pretending the psychology of crowds will stay on a Monday to Friday schedule. Now, to be fair, and this matters for credibility, there are powerful reasons banks want stablecoins. SoFi's announcement frames SoFiUSD as settlement infrastructure that can be used across crypto trading settlement, card networks, retailers, business settlement, international remittances, point of sale, and even as a dollar-denominated asset in volatile currency regions. Whether every one of those use cases scales is a separate question, but the direction is clear. Stablecoins are moving from speculative edges toward boring infrastructure. Infrastructure is where the biggest risks live, because infrastructure is what everyone depends on when pressure spikes. If you make settlement faster, you free working capital. If you reduce fees, families keep more of what they earn. If you shorten reconciliation, businesses run leaner. If you can settle around the clock, global commerce becomes smoother. These are real benefits. But here's the shadow. Every benefit that reduces friction also reduces the time between fear and action. And you can already see where the world is heading, because regulators are building frameworks to make stablecoins boring. The United States passed a federal framework in 2025, the Genius Act, intended to push payment stablecoins toward high-quality reserves and stricter compliance, and to regulate how stablecoins are marketed, especially around safety claims. That's the problem lawmakers can target: reserve quality, redemption rights, supervision, disclosures, custody rules. But there's another problem they can't legislate away: collective human behavior when the easiest option becomes the fastest escape. So let's walk through a perfectly backed stablecoin crisis, because this is the scenario most people don't even imagine. It's Monday morning. Markets are already on edge. A big institution posts a disappointing update. Volatility spikes. Commentators start connecting dots. Nothing is confirmed, but uncertainty is enough. By afternoon, Treasury teams and large depositors begin moving money temporarily, not because they're sure there's a fire, but because they don't want to be the last person in the room if there is. Now imagine the fastest path is a bank-issued stablecoin rail. Convert, send, settle, done. If redemptions are smooth, that doesn't calm the system. It speeds up the flow, because success becomes proof. See? The door works. Use it. So outflows increase. As outflows increase, banks need liquidity. They raise deposit rates to keep funds, which squeezes margins. They tap short-term funding, which can tighten markets. Some sell liquid securities to raise cash. Selling pressure can push prices down. Falling prices make stress visible. Visible stress feeds rumors. Rumors drive more outflows. None of that requires the stablecoin to fail. The stablecoin is just the turbocharger. And here's the part that really matters. In modern crises, it's often not the bad assets that start the collapse. It's the mismatch between the speed of withdrawals and the speed of funding. Bad timing is the spark. That's why stablecoins are different. They don't just change money, they change timing. Now let's talk about another misconception that will absolutely show up in your comments if you don't address it cleanly. People will assume a bank-issued stablecoin is simply a bank deposit, but on a blockchain. That is not automatically true in the way they think. A stablecoin is a tokenized claim with specific terms. A bank deposit has specific legal and insurance structures. Even if an issuer is an insured depository institution, the stablecoin itself isn't necessarily FDIC-insured money, in the way people casually assume. The exact treatment depends on structure, disclosures, and the legal nature of the claim. So when viewers hear "issued by an insured bank," their brains jump to "guaranteed like my checking account." That may be the wrong mental model. And it's precisely why marketing rules and disclosures matter so much in this space. But notice something. Even if the stablecoin is safe for the holder, that doesn't eliminate the run-through risk. It can actually amplify it because a safer-feeling lifeboat gets used faster. Trust is a scaling engine. Now let's zoom back to SoFiUSD specifically, because their launch is a signal, not just a product. SoFi is positioning itself not only as an issuer, but as infrastructure, enabling partners to integrate SoFiUSD or issue white-label stablecoins on top of SoFi's regulatory and reserve framework. That's not one stablecoin story. That's a template story. And templates are how finance changes. Nobody wakes up one day and says, "Today we rewrite payments." Finance shifts because something becomes easier, cheaper, and scalable. Then everyone adopts it because not adopting it feels like falling behind. That's how instant money becomes the baseline expectation. And once instant becomes the expectation, the system has to survive instant stress. Here's a useful mental picture. Imagine the banking system as a city water network. Deposits are water pressure in the pipes. Loans and investments are where the water gets used. Everything works because demand is predictable and pressure drops are manageable. Now add a new kind of faucet, a 24/7 faucet that bypasses some of the old controls. It's incredibly convenient. It saves time. It improves service. But if fear spreads, everyone opens that faucet at once. The city can have plenty of water in total and still have a pressure collapse. That's a liquidity event. So what's the one question that matters most in the stablecoin era? It's not, is it fully backed? That's important, but it's not the whole story. The real question is, what does this new rail allow rational people to do faster during uncertainty? Because stability is the system's ability to survive rational people doing rational things at the same time. If you are a consumer, the takeaway isn't panic about stablecoins. The takeaway is that money is shifting from batch processing to real-time processing. Real-time reduces costs and increases convenience. It also reduces the time you have to react during stress. So personal resilience matters more. Knowing what you hold, what's insured, what's a token claim, and how quickly you can access liquidity when everyone else is trying to do the same. If you're an investor, the takeaway is that stablecoin infrastructure is becoming a competitive battleground. The winners won't just be the first to launch. The winners will be the ones who can prove trust and liquidity management under pressure, because that's where the next regulation and the next market fear will concentrate. If you're a business, the takeaway is simple. Stablecoin settlement can be a powerful tool, but relying on one rail, traditional or on-chain, without contingency is a mistake. In a fast panic, diversification of liquidity access becomes survival, not optimization. Now let's land this with the core idea that ties the entire story together. SoFiUSD isn't interesting because it's crypto. It's interesting because it's plausible. It's the kind of product that makes sense. Targets real frictions. It offers clear benefits. It's designed to be used, not merely traded. And products that make sense scale. When they scale, they change behavior. And when behavior changes, the system's risk profile changes, even if every single token is perfectly backed. We are building a world where money can run at the speed of emotion. That's the real shock. So the next time you hear fully reserved and regulated, don't stop there. Ask the deeper question, what does this enable people to do at 2 a.m. with one tap, while everyone else is still deciding whether the rumor is real? Because in the stablecoin era, the first run might not look like chaos. It might look like normal finance, until you realize the outflows already happened before the headlines caught up. If this changed the way you see digital dollars, stay close. Subscribe for the next chapter in how money is being rebuilt in real time. And tell me in the comments, would you trust a bank-issued stablecoin more than a traditional bank account? Or does the speed itself make you uneasy?